Most traders assume that more screen time equals more success. More charts, more indicators, more setups, and more constant monitoring must mean better decisions, right? But the truth is almost the opposite. The longer you're glued to the screen, the more emotional, reactive, and impulsive your trading becomes. And that's exactly what destroys consistency. In this script, we're breaking down why stepping away from the charts, yes, doing less, can lead to bigger trading gains, tighter execution, more confidence, and a calmer mind. Not because the market rewards laziness, but because the human mind thrives with clarity, boundaries, and intentional action. Let's begin with the reality many traders quietly live with: the burning belief that if they aren't constantly analyzing price movement, they're losing opportunities. That belief creates anxiety, and anxiety leads to over-monitoring. The screen becomes something like a slot machine. You're waiting for something to happen, waiting to pounce, waiting for movement. But waiting and watching aren't the same as analyzing and executing. This constant watching makes the brain desperate for action. When nothing is happening, the brain manufactures meaning or sees patterns where none exist. Instead of following your plan, you start convincing yourself that maybe this candle means something. Maybe this breakout might start early. Maybe that indicator flicker is your sign. Slowly, you stop trading the market and start trading your impulses. Ironically, the markets themselves don't require constant attention. Most of the time, nothing meaningful is happening. The market moves in bursts, in phases of calm and chaos. And yet many traders sit through hours of boredom, waiting for excitement. There's a famous saying in professional trading: amateurs trade all day, professionals wait. Professionals already know where price must go before they care. They mark their levels, identify their zones, set alerts, and walk away. They don't stare at every candle forming. They don't babysit the chart. They come when the market reaches the levels that matter. This single shift, from passively watching to strategically waiting, removes emotion and replaces it with structure. Another reason less screen time improves performance is because trading is a cognitive marathon. Unlike physical fatigue, mental fatigue sneaks up quietly, reducing the quality of your decisions so gradually you don't even realize it's happening. The first hour you're focused, alert, sharp, analytical. By the second hour, your brain starts adapting to the repeating patterns, absorbing information, and, here's the danger, beginning to predict emotionally instead of logically. By the third or fourth hour, the brain shifts from controlled reasoning into instinctive decision-making triggered by hope, fear, and FOMO. That's when traders chase entries, remove stops, hold losers longer than planned, or get out early from winners. By reducing screen time and trading only when necessary, you preserve your cognitive capital. You remain logical. You remain deliberate. You remain the decision maker, not your emotions. Let's also talk about one of the biggest killers of trading accounts: overtrading. The more time you spend staring at charts, the more setups you invent. You start taking B grade or C grade trades simply because you're available. If you think about any skill in life, quality beats quantity. A sniper doesn't shoot more bullets to improve accuracy. They shoot fewer bullets, more intentionally. A surgeon doesn't perform more surgeries in one day to become better. They perform each one carefully, precisely, and professionally. The market doesn't care how long you stare at it. It rewards discipline. When you limit your exposure, you reduce the temptation to force trades. You become picky. And being picky is a superpower in trading. Another benefit of stepping back is improved emotional regulation. Most traders think emotional discipline means suppressing feelings. But emotional discipline is actually about creating an environment where your emotions don't get triggered in the first place. When you stare at every candle, every tick, every micro movement of price, your nervous system reacts constantly. You get tiny dopamine hits when price moves in your favor, and tiny panic spikes when it pulls back. Over time, this creates a roller coaster of micro emotions, which build into frustration, fear, or recklessness. But when you trade less frequently and only engage when necessary, you avoid that emotional roller coaster entirely. Your mind stays calmer. Your reactions stay controlled. You enter the trade with clarity, not adrenaline. There's also the illusion of control. Many traders believe that watching the screen helps them manage their trades. They think if something starts going wrong, they'll catch it instantly. But trying to micromanage every candle usually leads to premature exits, because natural price fluctuations feel threatening. When you walk away from the screen, something powerful happens. You let the trade breathe. You allow structure, not emotion, to dictate results. You learn to trust your analysis, your stop loss, your risk management, and most importantly, yourself. The less you interfere, the more consistent your edge becomes. Now let's look at the psychological shift that happens when you trade less. When you reduce your screen time, you stop tying your identity to your trading session. You're no longer asking, "Will I win today?" Instead, you start asking, "Did I follow my plan?" Winning becomes a byproduct, not the goal. And that transformation is where consistency lives. When you stop trying to catch every move, you begin to accept that missing trades is normal. You start realizing the market will still be here tomorrow, next week, next year. Nothing is urgent. Nothing has to happen right now. The fear of missing out becomes replaced with the confidence of waiting. Another important point is creativity and clarity. When you take breaks, when you walk away, the brain processes information in the background. Your subconscious starts making connections you never consciously saw. You start noticing repeating behaviors in price, repeated emotional reactions, and cleaner setups. Many traders report that their best ideas come not while watching charts, but while taking a walk, journaling, or reviewing their trades after the market closes. Stepping away isn't lost time, it's strategic processing time. Less screen time also forces you to rely on a structured strategy rather than instinct. If you only check the market at predetermined times or levels, then you must plan ahead. You stop trading randomness. You start trading intention. You define exactly what qualifies as a trade and what doesn't. You set alerts and review levels instead of chasing candles. And by doing that, you become process-driven rather than emotionally driven. A critical part of this transformation is trust. Many traders don't trust themselves. They feel the need to constantly monitor because deep down they fear they'll get it wrong. But here's the truth. Confidence is built through follow-through, not watching. Every time you let a trade run according to plan, you strengthen belief in your system. Every time you avoid taking an unnecessary trade, you reinforce discipline. The more you reinforce discipline, the less temptation controls you. And once temptation loses power, trading becomes calm, not chaotic. Let's address one more factor: lifestyle. Trading is supposed to be freedom, but many traders end up prisoners of their screens, isolated, anxious, exhausted, and mentally flooded. When you reduce screen time, you reclaim your life. You return to balance. Sleep improves, stress decreases, decision fatigue fades, and hobbies regain space in your life. A rested brain performs better. A fulfilled person trades better. A trader who isn't consumed by charts becomes objective rather than emotionally attached. Over time, something remarkable happens. Your results begin improving, not because you suddenly found the perfect strategy, but because you removed the self-sabotage. You take fewer trades, but your win rate increases. Your risk to reward improves because you're patient enough to wait for cleaner entries. Your losses become smaller and less emotional. Your identity slowly shifts from someone trying to win money to someone executing a refined process. And that shift is where real growth happens. Once you detach from the need to constantly trade, you start seeing the market as a long-term game, not a daily lottery. You stop obsessing over today's outcome and start focusing on the bigger arc of progress. Consistency forms, confidence builds, and ironically, the less attention you give emotionally to the market, the more the market rewards you financially. So, what's the takeaway? Less screen time doesn't mean less effort. It means better effort. It means trading smart, not trading more. It means valuing quality over quantity. It means setting rules and actually honoring them. It means stepping back so you can see clearly instead of reacting blindly. If you want bigger gains, more confidence, and more consistency, then give yourself space. Step away. Let the market come to you. Train your mind to wait. Become the trader who acts only with purpose. Because in trading, the goal isn't to do more. The goal is to do less, better. That's where the real edge lives.